Joining us now to explain how she feels, Kelsey Berro, fixed income portfolio manager at JP Morgan Asset Management. And you guys are, if there was a debate, you could be here and former President Lacker could be here. But you say, and this is really interesting, Kelsey, the Fed was created, Federal Reserve, in 1913 in response to the banking crisis of 1907. Not even in their wildest dreams did they think that they'd have the dual mandate of unemployment and inflation as their most important things. They were created to manage the financial system. What the hell happened?
Well, that is exactly what they're doing. So thank you for having me on and for starting with that. The Fed has to keep in mind that above all else, their biggest role is to be the lender of last resorts. And that's why probably the most appropriate thing for them to do at this moment, given the amount of uncertainty in the banking system, is to pause. Now, on the other hand, you talked about the two-year yield. It's moving higher today. The market is pricing in 85% probability of a 25 basis point rate hike. What the Fed normally does is they do what the market allows them to deliver. Right now, the market is saying, go ahead, do that 25 basis points. It may be too much, but I think what the Fed is going to really need to focus on here is the dot plot. What are they communicating beyond this most upcoming meeting? Because 2 weeks ago we were talking about the Fed getting to 5.5%, 6.5%. That's completely out the window. And I think the real reason why is because even if they pause and inflation is high now, inflation is coming down, and this stress in the banking system is ultimately disinflationary.
If we had Kevin Warsh on also, and I asked him, just give me an algorithm for where rates should be. What is normal rates? And if you were to just purely do that based on giving people a real return, you can take an inflation number and you can find out where you should be. But that locks you into this weird box where you're absolutely certain that your answer to inflation is demand destruction and bringing, higher unemployment. Lower GDP, a slowdown in economic activity. You're so sure that's it because you're locked into this. I got to get rates normalized to where they're above inflation. But with all that, that's like operating in a vacuum. There's other things happening, aren't there? They seem to have lost sight of why the Fed was created in, as you say, 1913.
Yeah, so I think this gets down to the idea that monetary policy and the Fed funds rate is a very blunt tool. And really, it only impacts the demand side of the economy. So that is really the only way that they can operate. Now, on the other hand, they do have the liquidity tools, and they have been using those. They have been putting backstops in place. But as it relates to their price level stability and their maximum employment mandate, what they have interest rates. That's what they have. And they've reset interest rates significantly higher. It is important to note that this is the most aggressive rate hiking cycle since the 1980s. And what happens when you move that quickly is ultimately you break things. And that is essentially what we're seeing in the banking system over the last 2 weeks.